Hey friends, there's some scary stuff right now being proposed in the arena of tax code. And so with the presidential election forthcoming in November of this year, the candidates are sharing their thoughts on taxes. This is not going to be a political post today. I'm not sharing my side or which candidate I'm voting for, but I do want to look at Vice President Harris's proposals in terms of tax code and how that may impact dividend investors in the future, myself in particular. So as you can see on the screen in front of you right now, this is not the entire list of proposals, but these are some of the proposals from Vice President Harris in terms of her platform for reform of our tax code. And one of the big headlines that's been catching waves on the news is this thought that, hey, let's tax unrealized capital gains at a level of 25%. Now, initially, this would only apply to those with net worth of $100 million and up, but who knows, over the years, that level may come down quite a bit. It may impact and affect more and more people over the years. And so the idea here is, hey, someone bought an asset or a stock at this level, it's appreciated up to this level, they haven't sold it yet, but there's some unrealized capital gains in there. And so what Harris is proposing is, hey, let's go after those and tax those unrealized gains. This has sent some shockwaves through the news because it's a predicament for any investor to be in that kind of situation, because when unrealized gains are taxed, where's the money going to even come from to pay those taxes? And as we all know, stocks fluctuate. And so one year, the investor could be taxed on these gains, but the next year, the investor could very well be underwater on the same stock. And is there a rebate now for those taxes that were paid? Probably not. And so it gets really confusing and could create a situation that just makes investing overall really daunting. But let's keep going. As you can see on the screen in front of you right now, the next thing I want to share that's part of Kamala Harris's platform is this idea that, hey, long-term capital gains. And this includes qualified dividends, because right now qualified dividends that I receive from my dividend-paying stocks, like my number one stock, Starbucks, these are qualified dividends. Right now they're taxed as long-term capital gains, which is a pretty efficient tax rate for most people. For the majority of Americans out there, it's going to be about 15%, but it depends on tax brackets. But long-term capital gains historically has been a pretty favorable tax rate, and it's been kind of the cornerstone of my own platform as a dividend investor. It makes reinvestment very efficient in terms of taxes, and it makes paying bills from dividend stocks very efficient. But let's check it out. Check it out on the screen right now. What Vice President Harris right now is proposing is, hey, let's reform the tax code and let's go ahead and tax long-term capital gains and qualified dividends at the ordinary tax rates. And so this would increase, generally speaking, I'm speaking here very much in generality, this isn't tax advice, but generally speaking, ordinary tax rates are not as favorable. They're higher. They can be a lot higher for people who are in higher tax brackets. And so it kind of makes one think quite a bit about the dividend strategy and how one might play the game going forward if these types of ideas were to actually be enacted in policy. But let's keep going. As you can see on the screen, the last pillar of Harris's platform, and this isn't the only 3 reforms to tax code, but these are the ones that caught my eye, was, hey, let's increase the corporate taxes from 21% to 28%. Obviously, this is a pretty large increase, and it would probably affect a lot of companies that I own. Now, the assumption and the thought exercise for today's analysis is, hey, I'm going to assume that all of this happens. I'm also going to assume on the first one, the unrealized capital gains, that eventually, hey, it's not just people who have a net worth of 100 million and up. It applies to everyone. I'm just going to make those assumptions because I want to go through a thought exercise today, and I want to share with you 5 ways in the future, if this actually comes to fruition, how my strategy might change, how I may look at things differently. How would this affect dividend investing as I have come to know it over my decades of experience. It would actually change things probably quite a bit. Let's talk about that. So the first point that I want to share on the screen with all of you, this one really speaks to this idea of taxing unrealized capital gains. And so if unrealized capital gains get taxed, it really creates a nightmare for any investor. It's a logistical nightmare. It's a cash flow nightmare. It's just a very daunting situation to be in. But there are assets out there that one can purchase that do not have capital appreciation. In fact, there are assets out there that will either stagnate in share price or even lose a little share price over time so that they do not have capital appreciation. I've spoken about some of these on my channel over the years. Shout out to The Income Factory, the book by Stephen Bavaria. I'm going to link to my review of that in my pinned comment below. And shout out to my friend, the Dividend Monster, Greg, over on Instagram. I'm going to link to my interviews with him in the pinned comment below as well. What's interesting is I think Greg and Stephen Bavaria kind of emerges as a winner if all of these tax ideas come to fruition, which is a big if. Of course, this is a thought exercise. But as you can see on the screen in front of you right now, what's interesting is let's just look at a few examples. So there's a closed-end fund that I've been looking at. It's called FOF. It's the Cohen and Steers Closed-End Opportunity Fund. It's called FOF because it's really a fund of funds. It's a fund, a closed-end fund that owns units in many other closed-end funds. But anyway, it's yielding about 8.2%. It pays monthly distributions. And if you look at the share price over time, it's kind of been flat. It's been in this $12, $13 range for many, many years. It just trades flat. There is no capital appreciation. Why is that? All of the benefit of owning this closed-end fund comes out in the form of distributions, dividends, distributions. Now, what's great about this is if, let's just say, we were all taxed on unrealized capital gains. Well, I could pivot my strategy and own assets like FOF that do not have capital gains. And so that would simplify my life because I would not have to worry so much about capital gains anymore. And so that's just one thing that starts going through my mind. Another example, as you can see on the screen in front of you right now, some of you remember that I used to own this one. I'm very much thinking about adding it back to my portfolio, the Global X S&P 500 Covered Call ETF, or XYLD. This one has pretty much traded sideways in share price over the years, and it's yielding 9.14%. I think over very long periods of time, I actually think the share price on this one will erode a bit, and so there probably won't be a problem of unrealized capital gains. In fact, I think it will lose capital over time, but it's like an annuity. It will just keep paying that yield. So the value to the investor, to me, it will all come through in distributions. It won't come through in capital appreciation. And so that helps me in an environment where I have to manage cash flow, I have to manage taxes, and I don't want to deal with unrealized capital gains and paying taxes on unrealized capital gains. That's the first thought that goes through my mind in this particular scenario. So what I want to do next is I want to share another thought. I have another thought too, and it's kind of related to the last one. It's interesting. Again, this is just a thought exercise. I'm going to take a wait and see approach. I'm not making any big changes in my portfolio, but I'm thinking about all this because I see things like this out there, and they do get me thinking. They get me thinking quite a bit. But as you can see on the screen in front of you right now, the next one is, hey, this distinction in qualified dividends versus ordinary income dividends, it doesn't matter anymore. And so for many years, I have been preaching as my strategy, primarily, I invest for qualified dividends. Why do I invest for qualified dividends? Because they're taxed as long-term capital gains. Why do I do this? The distributions that come forth to me are more tax efficient. Remember, I invest primarily in taxable non-retirement accounts because I use my dividends right now in my 40s to pay bills. And so it's always been efficient for me. Even when I'm reinvesting, I feel better paying qualified long-term capital gains on my reinvested dividends than paying ordinary income taxes on them, which is much higher. And so for me, that's been the cornerstone of my strategy. But everything changes if this idea that qualified dividends, long-term capital gains, tax treatment kind of goes away and it's all just taxed as ordinary income. Remember pillar number 2 of the Harris tax strategy that I shared at the beginning of this presentation. Everything changes, as you can see on the screen in front of you. Again, this is a shout out to the Stephen Bavaria income factory strategy again, because you start thinking, hey, historically I've bought these dividend growers. Even more recently, I've bought sin stocks like Altria and BTI. I'm taking a heavy concentration of sin stocks. I don't want to be so heavily concentrated in one industry, but I do it because they're paying qualified dividends. But at a certain point, boy, if this tax strategy comes to fruition, funds like FOF and XYLD and other REITs, closed-end funds, BDCs, all of those types of instruments that historically have had a higher tax rate, well, everything now is going to have the higher tax rate. So I don't have to distinguish between qualified dividends and non-qualified dividends. They're all being taxed at the higher rate. If they're all taxed at the higher rate, I may make different decisions. I may not just put all my eggs in one basket, which I have recently with the sin stocks, to get that preferential tax treatment. Well, nothing has preferential tax treatment anymore. And so I would look at all of these various opportunities and you'd probably find me, especially combined with bullet point number 1 that I just shared, really taking a hard look at closed-end funds that have no capital appreciation, that pay monthly dividends, that pay a high distribution rate as part of my strategy. That would really make sense for me personally speaking. Of course, not tax advice. I'm just sharing my own personal journey here for fun and entertainment through this hypothetical scenario today if all of this came to fruition. But I have more. As you can see on the screen in front of you right now, number 3, I want to share another point with all of you. And so this is a thought around corporate taxes increasing, because we see that Harris is proposing, hey, let's increase corporate taxes up from 21% to 28%. In that kind of environment, I don't think the economy is going to do well. I don't think corporations are going to do well. I think it's going to hurt corporations. I think it's going to probably cause more automation at corporations, possibly some layoffs. I think the consumer is going to have less spending power. Generally speaking, I don't think taxing the corporations at this high rate is a positive thing for the economic growth engine of our country when I look at it that way. And so I'm not trying to take sides here or make this video political. I'm just trying to share from a pragmatic standpoint what might happen. But if that happens, what would I do? As you can see on the screen in front of you right now, historically, I have been investing in dividend growers. I have been investing in some of the best companies in the world that also happen to pay dividends. And I've been doing that because they grow the dividends over time, and they have benefited from a robust, strong, growth-oriented economy. If the economy slows down with higher corporate taxes, which I'm assuming it could, again, my strategy may skew more towards high yielders. Because let's go back, I know I'm quoting it a lot today, but this whole concept, this whole video really got me thinking about the income factory again. Income factory style investing, it could win again. And why is this? This is something that my friend Greg really taught me when I interviewed him on this channel and also on his own Instagram, which I'll link to in the pinned comment. With my strategy, historically, the way it's worked so well is I have invested in companies that have grown their EPS, their earnings per share, over time, over many decades. And as they've grown their earnings per share, so has the dividends grown. Dividends follow earnings. Dividends follow free cash flow. They follow the growth, the economic power of the enterprise. That's my strategy, and I benefited a lot from it over the decades. Greg's strategy, or Stephen Bavaria's strategy, is a little bit different. They're not really necessarily relying on, all the time at least, on companies growing, because a lot of these closed-end funds, they're credit facilities. They're offering loans, senior loans, different types of loans to businesses They want the businesses to do well, but at the end of the day, what matters the most is that the businesses can do well enough. They can do well enough to pay their bills, to pay back their loans, to pay the interest. And so it's a different kind of thing when you think of, hey, an environment where maybe businesses aren't growing as quickly. Boy, again, I might be thinking more towards current yield, closed-end funds, opportunities that don't need to really grow that much. They're just kind of paying a good yield by meeting their basically operating charter, by paying their bills. And so again, that is interesting that points 1 through 3 so far get me thinking a whole lot about income factory style investments again. But I have 2 more slides to share with you today, as you can see on the screen in front of you right now. The next one is this idea of selling stocks. It doesn't matter so much anymore. Having a large unrealized capital gain, it could be an extreme liability. Again, here I'm making the assumption that we all eventually, this tax on the 100 million plus trickles down to everyone. And it's so interesting that in this kind of scenario, it might make sense just to sell stocks with capital gains. Because if you're going to be taxed anyway on your unrealized capital gains, you don't really want to have unrealized capital gains. Having unrealized capital gains becomes a tremendous cash flow and financial burden where it would make sense to probably sell stocks that have unrealized capital gains and redeploy funds. And so I would probably try to manage my portfolio again to avoid having too many unrealized capital gains. Here's where it gets even more interesting though. There's long been an idea in our dividend investing community that I've heard so many times over the years. And I know some people have actually put this into practice and it's worked for them, but I've been a critic of this. The idea goes like this. Hey, Ian, I'm going to invest all my money in ultra high growth stocks that don't pay dividends. And I can take on the risk, Ian, because I'm really young. I'm a 20-year-old and I've got many working years ahead. And I'm going to put all my money in the highest of high growth. When I'm ready to retire, say in my 50s or 60s, I'm going to sell it all. I'm going to sell it and I'm going to put it in dividend stocks, and then I'm going to live off my dividends. And the people who have pitched that strategy to me, historically speaking, the idea is they can grow the capital, the nest egg, faster that way. That's their hypothesis. So they have a larger portfolio that when they are retired, even after paying all the taxes on cashing out, they can cash flow enough to pay the bills, to live off of it. Obviously, this becomes even more interesting in a account that is tax-free, a retirement account. But I'm saying there are people that look at it this way, even in taxable accounts. And I'm looking at it today in this video from a taxable account strategy, because that's typically how I do things. And so historically, I've been a critic of that for really the tax reason. The primary reason I've been a critic is, hey, when it's time to sell, there's going to be huge capital gains, and then the portfolio is going to take a huge haircut, moving it from the high growth to the dividend stocks. But if the tax code is going to tax unrealized capital gains anyway, I'm not such a critic of that anymore because everything is taxes now. There's no advantage to going just the dividend route. Now, I'll add the caveat to all of this that historically, I have invested in dividend stocks with the belief that not only is it a great strategy because it's tax efficient, historically speaking, but also the companies that I own, especially my core stocks, they tend to be some of the best companies in the world. And so historically, part of my argument against that strategy has been tax related, but it also has been related to, hey, dividend growth investing, it's one and the same. The best companies in the world that may have the best opportunity to grow over very long periods of time historically have been the dividend growth stocks. But again, I rethink all of that with some of these proposals to the tax code. And so just food for thought, that strategy that I once critiqued, it becomes interesting at this point, not necessarily for me, but just from the standpoint that, hey, everything's getting taxed, even unrealized gains. But let's keep going. As you can see on the screen in front of you right now, I have one more point to share as it pertains to this video. And so I really start thinking, Oh boy, this is interesting. These are a lot of changes that would fundamentally change the way I invest and probably most people out there in the United States invest. If this came to fruition, if the assumption in the video today came to fruition that all this applies to everyone, including the tax on unrealized gains. It gets me thinking, boy, should I be really looking even more heavily than I am already at retirement plans, tax-advantaged vehicles, things like that. That being said, as a caveat, I read something recently in Australia that superannuations over 3 million in size are going to face unrealized gains, capital gains taxes. And so if you're watching from Australia, could you actually put in the comments below if that is correct, if that law was passed? Because I read in multiple different sources that this law was being considered. I don't know if it ever passed, but there was this, by the way, if you're watching, superannuation in Australia is kind of, to my knowledge, a comparable here in the US would be maybe like an IRA or a 401k. It's a retirement style vehicle. Now, the difference in Australia is the superannuation is really cool because not only historically did it provide compound growth without worrying about taxes, but they also had this concept of franking credits, which gave tax benefit above and beyond the value that the stocks themselves were creating, to my understanding. So there's some differences. But again, at a high level, what I read is, hey, the government for superannuations that are worth 3 million or more wants to tax unrealized gains. And superannuation, hey, wait a minute, that's a tax advantage retirement account. And I start thinking, okay, could this happen to the 401k in the United States? And so basically, it is confusing to be an investor. But with that, what am I really doing right now? I'm trying to learn all I can about these proposals, and I'm trying to prepare in my mind kind of how would I look at it. But realistically right now, it's status quo, it's business as normal, because I'm not going to change anything until anything actually changes out there. And hopefully none of this comes to fruition. As you can see on the screen in front of you right now, the last slide is in reality, I'm just going to wait and see what happens. I'm going to hope for the best. I subscribe to a bar of soap analogy. I don't like handling the portfolio too much because like the bar of soap, the more I'm handling it, the less soap is left. And so I want to avoid any major changes in the portfolio. But hey, if I see what's happening around the world, I see what's being proposed and may have even passed in Australia. I hope in the comments someone can kind of educate me there from Australia what ended up happening. But I see kind of where things are going. And so I may skew future investment decisions more towards kind of taking all of this into account, but I am going to hope for the best here for quite some time going forward. And worth noting, it's just a reminder to me that the world we live in, it's in flux. It's important just to live life and enjoy life and spend some of this money that I've saved up, spend some of the money and enjoy it while I can. You know, boy, I earned it. I want to enjoy it. I'd rather go ahead and do that right now. And so that's something always to remember as well. Everyone, if you enjoyed the video, please go ahead and click the like button. It really means the world. And please put in the comments below, how would you look at it? If some of these tax proposals came to fruition and affected everyone, how would your strategy change? How would you look at it? Do you have any clever ideas? I was kind of proud of some of the clever ideas I had for today. Put in the comments below. I'd love to know. If you have not already, also please consider subscribing. It really means a lot to me. Before I go today, in terms of full disclosure, I own the stocks mentioned today. I'm long Starbucks, ticker SBUX. I'm long Altria, ticker MO. I'm also long British American, ticker BTI. Also, I'm considering adding positions in ticker FOF and XYLD. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the stock market. I'm just sharing my journey for fun and entertainment. It's not advice. This is also not tax advice either. I'm just sharing my hypothesis in the video today and a hypothetical situation. I love you all. Thank you for watching. I'll see you in the next video.